Hey, this is Sasha, and welcome to episode number 126 of Let's Talk Stocks. And in this episode, we're going to focus on getting paid as you wait for stocks to get cheaper. And we're going to do it with options. So I'm going to share with you this strategy. Typically, you need a little bit more capital in your account to do this. You also need options capability, along with higher level of options trading, meaning you need to be able to sell naked options. So it gets a little more dangerous, but I want to show you an advanced strategy so that way you can see how money is really made in the markets and seeing the bigger picture. Keep in mind, of course, any trades that we discuss here are strictly for educational and illustrative purposes. I think all my viewers are smart enough to understand that, but by all means, here's a disclaimer for you just in case. Also, a couple of quick notes here on some of the news and things that are happening. The live classes schedule was posted on the website. So if you are a Video Charts member, go ahead and go to the website. When you go to the TRADERSFLY website over there and you pull it up, so let's just take a look over here. And if we go right there and go to the website, and then you go to the live classes section right there at the top, click the live classes, and you'll see I posted a great deal of schedulings and things like that for the next month and a half to 2 months. So there's one or two that may change just simply for the time. But if you're a video member, there's kind of the list. And if you're not, and you're on the newsletter list, there's also one or two that are for the newsletter subscribers. So by all means, go ahead and register those for those classes, and you'll get that link in the newsletter as they are sent out. So in either case, that's some of the quick announcements as far as the live classes schedule. Then I'm also working on the Options Mastery number 3 course, which is the Iron Condor course. Probably will take me 6 weeks, might take me 8 to 10 weeks to wrap it up. It is filmed, it's been filmed. We're just doing the editing, the study guide, that kind of thing. So that's kind of the next big project on the list. And then also later on this weekend, I will post a couple of bonus webinars for the technical analysis members. So people that have the technical analysis blue course, we'll schedule a few webinars here sometime in the future to talk about Bollinger Bands, to talk about some other indicators, all specifically related to technical analysis. So probably by Monday, take a look at the schedule again, and you'll see as well about those webinars, when they're scheduled and what they're all about. So in either case, today's goal and focus is we're going to take a look at ultimately getting paid to wait in order for that stock to come back to us. And we're going to do it with options. Now, keep in mind, what we're doing here is a naked strategy. Naked means you're not covered or protected, which means you can get assignment. But if you have a market that's constantly heading higher or being really strong, I mean, the last few days, it's a little extended and it's been pulling back. But if you have a market that's constantly been pushing higher, and you still believe the market is going to go higher, okay, so you still believe that, for the long haul, the market is going to go higher or that stock is going to go higher, this strategy is great because it allows you to say, hey, I want to own this stock at a certain price below this level. And you can get that stock at that level, and you get paid to kind of wait for it, because if it doesn't reach that level and it continues to get higher, you just simply collect the premium and you get paid to wait. Now, again, a couple of caveats, because nobody's going to give you anything in the market. So the big problems with this strategy, number one, you will get assigned the stock if it hits your price target. Number two, if it does hit your price target and you get assigned, you can also have some problems, because if the stock continues to go lower against you, well, you're assigned at a higher price. Now, usually it's not going to happen within a day where, it's a 10 or 20 point difference on a $60 stock, but it can continue to head lower if you got stock assignment, in which case you could just sell out of the position. Number 3, you need to have a larger capital account because you are going to be able to buy stocks. So you need to have more capital in your account. And number 4, you also need to be able to trade options, and not just regular options. You need to actually be able to trade and sell naked options. So I believe it's a level 3 or level 4 options level as far as the requirements in your brokers. So let's take a look at the basics of how this works and how you get paid and just some of the risks associated with it. So in general, let's just say we're going to do 2 kind of stock examples. And here I'm going to do Caterpillar because it's been selling off quite a bit. So it's a good example to somewhat use for this. They've got some accounting problems and things like that. So for you, if you're looking at this stock in the long haul, you want to own it in a retirement account, and you say, well, they probably won't have any major issues. I mean, it might come down to, let's say, 80. Again, these are all just hypothetical concepts that I'm sharing with you. But let's just say you assume, well, it'll probably go down a little bit further, but it's not going to be that bad. So I actually don't mind owning that stock at, let's say, 80 or 85 or 75 or something around that level. Because you can see the last time it was at 80, we were pretty much in November. So basically that gives you a pullback from the highs. If you look at it from about the $98 level, and we go from the highs, that gives you a pullback of about 18% or so. So if you look at that little lower upper left area there in the box, actually it's right above my head right there, you can see that 18% right there. So anyways, that gives you about a pullback of about 18%. So if you're looking to own this stock and you don't mind getting in it, what you can do is sell a naked put. Okay, so this is how a naked strategy works. And this is great. If you have a lot of capital in your account, let's say millions upon millions of dollars, you can do this all day long, especially on a market that heads higher. But let me show you how this works. So what I'm going to do is pull up Caterpillar here. So here's a Caterpillar example. And here what I'll do is I'll go, let's just say 71 days out, because I could go to the 40 days out, right? Because if I go to the 40 days out, and I go to 75, okay, 75 is kind of my sweet spot, maybe 80, that's what I'm looking at. At 43 days out, I only get 27 cents of premium, and then I could be assigned the stock. But it's only a 6-7% chance that it would kind of get there. At 80, I have a 14-15% chance. So in theory, it's 85% chance for me if I'm the seller. Okay, so that's okay, but if you go out a little further in time, and let's just say we go 70 days, you can get a little further out for a little more premium. Now, granted, you're getting paid to wait, right? And since it's 70 days, you get a little more money because you're waiting longer. So here, what I can do is go to, again, 75 days. It's about a 12% chance it's going to go against me. So about a 90% chance that I'm going to get in and kind of it'll expire worthless. But here what I can do is simply we'll just right click and we'll sell, and we'll just sell a single. Okay, so when you sell that single, you get that 66 cents on that premium. So here you can see we're at 68, here's 58. So when you go ahead and put in the trade, it's going to be about 60, 62. You can see it kind of moving around. Anyways, it's not important right now. Learn the concepts, learn the theory, then you'll understand how it works. So here's how this profit picture looks. Okay, so let's get rid of some of these slices so that way you can see what it's going to really ultimately look like. So what you're doing here is you're selling insurance on the stock. Ultimately, that is what you're doing, is you're selling insurance on the stock, which means the person that buys the put right here, if that stock gets to 75, because maybe they have a ton of shares, if it gets to 75, they can put that stock to you at 75. So say it gets to 60, they can still sell it and you're going to be forced to buy it at 75. So basically, you're selling insurance on this stock at that $75 price level. Okay, so typically this is what you're doing. Okay, so right here, you're selling insurance right there. And every day that stock stands still and doesn't move, right? you collect the theta. So right here in this example, our theta is $1.69 right there. So that's how much we make on a day-by-day basis if that stock doesn't move. The white line right here is our current line, current profit and loss picture. So on the left here, what we have is the amount of money that we would make, okay? The bottom, what we have here is the price of the stock. And you can see that right there, the green line represents the expiration date. So that is on 5/20, which is the May 20th, 2017. At expiration, you would basically, as I roll the mouse over, make $62 because I'm selling one contract multiplied times 100 shares, right? Or 100. And you get $62 for that premium just simply for waiting. Now, you do need more capital for this, of course. Buying power affects 7,500. So you need more capital, but you can see how powerful this can be, especially as you start scaling up. So let's just say you sold 10 of these. Okay, so if I sold 10 of these, and now you're making about $590, $600 just simply for waiting for that stock to get to 75. If it bounces around over here, let's say it gets to 83, it goes to 93, it goes to 78, 79. You know, I mean, your overall money on the amount that you would see in your account, at some point, it actually could be negative right here because you can see that white line is the profit and loss today. But remember, let's say as the stock keeps heading down, okay, right here to 89, that'll take a few days. So I'll move this date time frame right here, which is on this lower right area. I'll continue to move it up. And you see what happens to that white line. That white line starts getting closer and closer based on the theta to that green line, right? So let's say then it gets to 89, okay? So you can see now I'm actually profit and loss of about $45. Then it continues to, expire. There's a few more days that continue to tick, and that white line continues to get closer. And even if it continues to get higher or can get lower and lower, the stock price continues to get lower. As long as you run out of time before this gets all the way down to 74.99, you're perfectly fine, right? So what you're doing here is ultimately selling this insurance, and with time, this continues to expire and decay, and you're collecting that time premium and so forth. So let's look at this from a basic perspective. Okay, so let's backtrack a little bit. So can you get out of this earlier? So let's say you're right here and you're already profitable $400 or $500. Absolutely. You can get out of this at any time. You just take the difference of what you sold it for and then what you bought it for because of the time expiration, and you can go ahead and get out of it earlier. Can you let this expire? Absolutely. You can just let this sit and expire and you don't have to worry about it so long as the price is above 75. Now, of course, the big concept, the problem here is if it gets below 75, you are going to get assigned. You're going to get and be forced to get 100 of those shares. And here, because it's 10 contracts, it'll be 1,000 of those shares, right? Because each contract represents 100 shares. So in either case, it's going to cost you in a big way because you can see the buying power effect right here. It's actually $75,000, right? So they're going to hold about 75,000 of your dollars in order to do this trade or put this trade on. But you can make $600, for just being there and just letting things sit. So that's one of the great things about these trades is you can let them sit and they'll just continue to rot and expire, and you collect that premium or that theta right here. In this case, it's $16 per day because we have more contracts. Now, the flip side could happen. All of a sudden, the stock could just start bouncing. So if it starts bouncing to 100, yeah, you could get out of it tomorrow. If all of a sudden all these problems go away, the market goes higher, you could get out of it tomorrow, you can get out of it next week, 4 weeks from now, 5 weeks from now, you can get out of it early. So again, the big problem here and the risks that you need to understand is that if it gets to 75 and lower, basically 74.99, you have problems. Now, if it gets here, let's say, pretty bad case scenario, if it gets over here, right, and you have, let's just make things simple as far as one contract goes. If it gets right here and you're at $73 and you still have, well, right now we're on today's date. So let's say it takes a couple weeks to get there. So we'll just continue to, let things expire. So you're down about, call it $365 on one contract, on selling one of these contracts, and it's below 75. Should you take your loss? Well, you could get out of this and you lose on the contract, so you would buy it back. So what do? Well, you create an opposite order, okay? Or another case, let's right click and analyze opposite trade. So you would buy it back. Of course, the price difference would be different. You would be at a loss simply because you're doing it later on in time, but you would get a loss of about $368, $370. So you could get out of it and buy it back for a worse amount, and therefore you would lose that difference, but at least then you don't get assigned in the future. The other option, or the other variation that you could do, is simply let it continue to go ahead and get lower. And let's say it gets to 69 or something like that. And then if it expires, you're still going to get assigned at 75. Okay, so you still get to keep this premium because you sold it at 63, but you're getting assigned. So again, two major problems. You could get out of this contract if it goes against you at, let's say, 73 or 70 or 71 for whatever the price or rate is at the time, which is going to be bad, right? So you'll take your loss of $400 and then you don't have to worry about assignment with the stock. Or number two, you could just let it continue to expire if you have the cash, the capital, and get assigned the stock. Because the reason you put these trades on is to look for the future, to hold on to these positions for the future and the long haul, because you don't mind buying it at a value. Because remember, at this point, if you understand the rubber band concept that stocks get too far stretched down or too far stretched up, they pull back. So here, if you're getting that stock at 75, you're down at 23% from the highs of 100, right? Because it was pretty much at 100. It goes to 75, so 0 to 100. Goes back to 75, that's 25% reduction. So you're getting it at a 25% reduced rate than what it was just, 2 months ago, because this is a 2-month, 71-day contract, right? So I hope that makes sense on how to really put these things on. Let's do one other quick example on Facebook and how this works on Facebook. So here's what you do. So let's say we go to Facebook, okay? Before we get there, just a few notes of what is a good stock to do this on. Well, you typically, in general, want to do this when stocks have a little more volatility. So stocks that maybe are $50 and more, or higher dollar stocks. That's why I said you need a little more capital. If you do it on cheaper stocks or stocks that don't move around a lot, let's say GE, here's the issue with this. When you go out with GE and you say, okay, well, here's GE, and you can see the stock's at $29, okay? And let's say I want an option spread at somewhere around $28, $27, okay? So GE, $28, $27 right here is only 10 cents. You're only making basically $10 on the stock. So if I sell this and I sell a single on the 26 and you analyze GE, you basically, if you look at it between the commissions and this and that, I mean, you're only making $9. Now, granted, it is a cheaper stock, so you need a little less capital. Okay, so here you can see you need a lot less capital, but you're not making as much premium. So let me share with you the Facebook example. Okay, so here's a Facebook example. Okay, and right here, when we look at Facebook, again, let's just say we go 70 days out. If I go 40 days, 40 days, you can't get as wide on the premium. So here with Facebook, let's take a look at the chart. We go to Facebook on the chart. Stock is at 137, and I could say, well, I missed the move, right? And if it's a stock you want to be in, but you missed the move, so how do you get paid to wait for it? Well, I could say, well, I don't mind owning it at 130, even at 125. It seems like a good deal because, man, I already missed it and it's been heading higher. So again, you want to do this strategy when you want to own the stock or you don't mind having the stock. It's not any more risky than doing other kinds of trades or strategies, because you need to know and understand what you're doing. A lot of people say that doing naked strategies, oh, it's very risky, there's big problems that go along with it. Yes, if you know and understand the problems, then you know what's coming up in front. If you don't understand the problems, if you don't know what you're doing, then yeah, of course it's going to be very risky. And I'll share with you how to combat that risk here in just a second as we go in this second example. So here on Facebook, and we're looking at it, I could say, okay, 130, 125. That's my key. That's what I'm ultimately looking for. So I'm going to go not 40 days, but again, let's go 70 days. It's a little bit wider. I can get more premium. So let's say 125. I can get about $1.55, on this one, which is great. But again, it's 20% chance it's going to go against me. So that's 80% chance that it'll actually just kind of expire. And you can see right there, 20% chance, that is the probability in the money, okay? So in either case, let's say I go ahead and sell a single here. Okay, so there's my sell a single. I get $1.54, which is a lot more than Caterpillar. Again, more volatile. It's a higher price stock by about $30 as well. So that's also contributes to that price of that stock. Let's get rid of some of these price slices here. Okay, so there's one. Let's get rid of this one. There we go. So, and reset our date back to today. Okay, so again, same thing. Left side is the profit and loss that we have. Right side, or the bottom, is our current price of the stock. Our theta on this stock right here is $2.72. And remember, that is exponential. So as we continue to make more and more money on a day-to-day expiration, that theta, watch what happens. It continues to increase. So here I get $2.78. Then as you continue, you'll see that it continues and you make more and more from that theta. So every day it just kind of continues to decay faster and faster. Anyways, the slope here though, it's a little misguiding, because the slope of it, since we're right in the center, you can see it's kind of less theta, but ultimately if you go over here on the apex, that's where the theta decay happens. So again, let me just backtrack this so you can see what that does. So here, $3.76 theta is kind of what we're doing on that whole contract. And then as I continue to move the date, you can see now we're at 4, then we get to 5, then we get to 6 and 7, and you can see 11, 12, 15, 17, 26, and 52, and then we're done. Okay, so the last day I make like $52 in a day. But if you're kind of, in a nice sweet spot right here at the stock stays at 137, then that theta just slowly starts to decrease, but ultimately the whole contract is actually accelerating to decay, right? It's going faster and faster to decay. So here's the thing about this stock. So if it stands still, you make money. If it goes up, you make money because you're selling at the 125. If it starts going down and you start getting a little worried and things like that, what you can do is get out of the contract and buy back your contract. So again, you right click, you analyze the opposite trade, you can buy back that contract. Okay, even if it goes below 125, say it goes to 110, again, you can buy back your contract. It's just going to be at a bad rate and you lose your $1,447 or so. Okay, so you can still buy it back, or you could simply let it expire, but then you get the stock assignment at 125, because that is what we are selling that stock for, or that contract for. So even if it's at, let's say 115, you'll still get assigned at 125. If it's 110, you get assigned at 125. If it's 105, you still get assigned at 125, based on the amount of shares that you sell. In this case, 1, so that means 100. If it was 2, okay, that would be 200 shares. So if you're looking to get 200 shares of Facebook, you have, a good size account. You're willing to spend about $25,000, $50,000 on these shares, but you think they're a little bit pricey. The market's a little bit too far extended. This is what you do. This is what you can do. You can sell contracts like this, and you can wait, and you can earn about $310 simply for just waiting and selling the option premium. Now, if you wanted to minimize your risk a little bit and you're saying, well, if we have a major problem in the stock for whatever reason, somebody dies like Mark Zuckerberg or something else happens, there's a bomb that goes off. If you really want to protect yourself, what you could do is ultimately protect yourself on these shares or contracts at another lower level. So say you're fine with owning at 125, okay? But if it starts getting to 100 and so on, there becomes some problems, right? The stock is moving very quickly. So what you could do actually is go ahead and buy another one. So you could buy a contract at, let's say, 105, and I'll just buy a single right here, and I'll analyze that trade. And you can see what this does is it actually caps my losses right there at 1,863, which means this is basically a vertical. You're selling a vertical, okay? Which means if that stock even gets to 20 or 30, my max loss is 1,863. And these are kind of the things that we cover in the options business verticals class. A lot of these vertical strategies, but here's kind of like a little bit of a taste of what goes on. So you can buy this position or contract for protection at 105. Now here, if I bought it at 105, the max I make is 139 because they take the difference between the 158 and the 19 cents right there, and you get that 138. If I didn't do that, I can make a little more money because I make 157, right? 158. If I get the protection, they take the difference, but it limits my losses, and also it reduces the capital requirement. Here, my capital requirement is only $2,000, okay? If I go and remove that, it's about $12,500 on the buying power effect. Now, what you can also do is take that 105 and go to 110, okay? So now you limit that to $1,375 as your max risk, but again, you make a little bit less. So you can see now we only make 125 rather than before at the 105. You would have made 137, and if you didn't have it at all, you'd make 156, right? So in either case, the more protection that you get, the less profit that you make. And it's a balance between how much profit you want to make versus how much risk you're willing to take on, right? So here you can see I've capped it at my max loss at 115, okay, which is right there. The most I'm willing to lose is 898. And then over here, what I make is 102. It's not 155 or 156 like just selling the naked, but I have a lot less risk, and I'm only really the buying power effect that comes into play is only about $1,000. Now here again, can you still get assigned? Yes, absolutely, because you're -1. Anytime you're short one and it goes in the money, that's a problem. Okay, so anytime you're short one and you're in the money, that's a problem. Okay, so in either case, but you can see how powerful this strategy can be, especially if you're willing to wait for the stock. You have a lot more capital. It's ultimately going to allow you to just sell premium time and time again. And this is great for markets that are overextended, especially in markets like this, but also markets that don't want to pull back or are pulling back lightly. So it allows you to, number one, make money while you just wait for that stock to either come in, or if the market keeps heading higher and let's say this stock goes into 150 or 160, well, you just let this expire and you could do another one another month or two later. And instead of at the 125 strike price level, you could move that to 135 or 140. So you just keep shifting it up with time, you know, and eventually it'll get a nice pullback or there'll be a sell-off and then you'll be forced to buy the stock. So again, keep in mind, very dangerous if you don't understand what you're doing, because you will get the stock if it goes against you. So keep that in mind. You need more capital. Not to mention, if you're doing naked strategies like this, you have to have a higher options trading level. You need that additional capital. And, you know, if it goes against you, well, you get that assignment. So, you know, for many people, they don't like getting the assignment. But if you're interested in owning that stock and you want it for the long haul, this is another strategy that you could think of and consider. So if you know what you're doing, if you understand the strategy, if you understand the concept, There's nothing wrong with this strategy or concept. You just need to understand the risks that are involved. Thanks again for joining me this week in another lesson. If you want to see some of the other training lessons that I have, click this button over here or watch one of the other video lessons right there. Or by all means, get on my newsletter list by clicking this button. When you get there, enter your name and email address, and that's where you can get access to some of the live classes that I do for the newsletter members, or get news and insights from the books, the courses that I continue to release. So get on the newsletter list, click the link, enter your name and email address when you're there, and you'll get those newsletters as they come out. Thanks again. In the end, remember, do what you love, contribute to other people, but most importantly, live life abundantly. I'll see you next time.